Sharp?
Yes, very well. We were very good friends. Like when he got married the second time, my wife and I bought 4 champagne glasses and a bottle of champagne and flew up to the Bay Area to celebrate. You know, okay, so we know each other.
Fantastic.
But anyway, the first time I met him, he presented himself at my door at the Rand Corporation and said, my name is Bill Sharp, and my professor at UC, I work at the Rand Corporation. I'm also trying to get a PhD at UCLA, and my professor, Fred Weston, said, why don't you talk to Harry about a thesis topic? And we talked about too many covariances in the one-factor model. And his 1963 paper explored the efficacy of the one-factor model. It's not, you have to distinguish that from the 1964 paper, which established CAPM, capital asset pricing model, which I had nothing to do with. And it's just, you know, all his thing. But he and I got him started on the one-factor model. And for a long period of time, the one-factor model was the thing. Now, during that time, Marshall Bloom asked the question, how do you, if something has a beta, the one-factor model uses one beta, it has a which is bigger than average, bigger than 1. Measure these things, the market would have a beta of 1. If something has higher than the average beta, will it be that high next time? And the answer is no. It'll be high, but not that high on the average. And will it be if it's, you know, and so on for the low. And so there was some work done on the before and after. What you observe versus what you got, and so on. Now, of course, there's a many-factor model in Barr-Rosenberg and so on and so forth. There's a history of how you estimate variances and covariances, particular factor models for estimating the covariances in effect, and there's a history of how good this is, and obviously we don't have time for the complete history.
Thank you. The next question comes from Vienna, Austria. Dr. Michael Fembeck of Gavin Magazine asks, in times of panic, investors can sell anything. Correlation numbers rise dramatically, and the figures of the past are virtually worthless. The only escape would be assets that are not freely traded or hedge funds without a long bias. Would you tend to agree with that statement?
No. Well, first place, just because you can't measure the because if it's not freely traded, you don't know what the price is. And just because you don't know what the price is doesn't mean that it's worth anything. And in fact, what happens is in times of panic, you sell off the most liquid assets. And I mean, well, it depends who's panicky. Let's take the Russian crisis, the liquidity crisis of when long-term capital management, LTCM, went bankrupt. Well, that was because it was terribly over-leveraged. Well, let's take better still. Let's take the market break of October 19th, 1987. If you were just plain long, or if you were short and long and unleveraged, but if you were just plain long, nothing happened. You know, by October 20th, panic was over. If you were terribly leveraged, you're dead. You're gone. You're bankrupt. Okay, so it depends who's now. What you have this business about, this nonsense about all the correlations going up. You have to distinguish between ex ante and ex post. Ex ante, you know, tomorrow might be a crisis, or it might not. Tomorrow might be a market break, or it might not. Your estimated correlations or betas or so on have to be an average over the possibilities that you might have a crisis and you might not have a crisis. Let's suppose a market break happens once every 3 years. Some terrible, you know, somebody, there's a liquidity crisis, or there's a portfolio insurance, which is not portfolio theory, but in portfolio insurance, has everybody sell because, or something happens. Terrible. Well, you have to say, and suppose it happens once every 3 years. So when you estimate correlations, you have to say there's one chance, or covariances, there's one chance in 600, or however many, trading days there are in 3 years, more or less, 750, whatever. There's 700 will happen, and all that minus one chances it won't happen. And so that your estimate averages over those. Now, if the break happens and you look at ex post correlations, well, you're looking at a day when the market went way down. Kind of beta at all goes way down. And that day, idiosyncratic risk is irrelevant. It's all, that day. So ex post, yes, all the correlations go to, 1, but that's just for that day. And so anyway.
So are you saying it's irrelevant to look at the correlation data on one specific day or one specific week?
Right. In other words, ex ante, when you place your bet, especially since these are not perfectly liquid assets, ex ante, you have to say the correlation is, let's say you have a one-factor model, and this thing has a beta of 1, and it has the idiosyncratic, idiosyncratic, the extra term on the outside at the end of so much of, standard, this idiosyncratic term has a standard deviation of, 0.1 or 0.2, and then the market factor itself has a standard deviation of, let's say, 0.2 or something like that. So that's your estimate ex ante. Ex post, the market went way down. It had a 3, 4, 5 a 10 standard deviation day. It can happen on a day. Over a year, it's more normally distributed. In fact, by a quarter, it is more. So, right, as you say, it is not meaningful to say all correlations go to 1 when you have a panic. What's happening when you place your bet is you have a possibility of a panic any old time, and that will get realized once in a while. And ex post, you will have big correlation, but that's not the way you place your bet.
This next question comes from Vienna, Austria as well. Rainer Sommer of A3 Echo magazine asks, for a private investor, your theory can be very mathematical and complicated. What are 3 key facts a private investor should keep in mind when allocating assets to a portfolio?
3? He wants 3?
He specifies 3, yes.
Okay, I'll give him 3. Diversify, diversify, diversify. Now that's the smart-ass answer. So let's do it better. Okay. So first, for an individual investor, he or she should should have 2 kinds of assets. Let's say a diversified portfolio of. I'm assuming that he doesn't have Superfund at his disposal, but he has a diversified portfolio of long positions, like a world benchmark, an ETF, an exchange traded fund that has a world benchmark, or maybe he has a little bit of he has quite a bit of SPDRs, S&P depository receipts, and maybe some small cap. Maybe if he's doesn't have to worry too much, he can overweight the small cap. But he also should he or she should also balance that against bond funds or some form of cash. And what he or she should do is to make sure he understands how much volatility there is in the equity part, and that he or she is comfortable with the volatility of the portfolio as a whole. Because if he's going to chicken out at the first time the thing goes down 2 standard deviations, and that's what a standard deviation is. You look at what happened in 1990, in the late 1990s. sure, it was good. Those were great years, but they are all less than 2 standard deviation moves. And then you saw what happened in the early 2000s. Those are horrible years, but they were less than 2 standard, or one, a couple of them were. One of them was a 2 standard deviation.
Statistically normal events.
Statistically, see them once, see them all. And if you're going to chicken out, when you got a 2 standard deviation move, you're going to chicken out the wrong time. You're going to, okay, so.
So it comes back to fear and greed, which you mentioned in the context of the rabbit.
Right.
To chicken out at the wrong time could be
so
really...
one, he should know he's supposed to diversify. Second, he should understand what